We are watching a shift in how software functions. We've moved past generative AI that simply organizes information to agentic AI, which autonomously executes tasks in the physical world. This growth is reflected in the market valuation, which is projected to climb from under $8 billion today to over $52 billion by the end of the decade, and are also moving to secure a stake in how these agents will eventually transact. But while an agent can negotiate a contract or manage an entire travel itinerary, it lacks a mechanism to settle those transactions. Every time money needs to move, the agent has to wait for a human to authorize the spend. Even in a fully digital enterprise workflow, the agent successfully handles every operational step until it reaches the final transaction. At that point, the automation stops. The limit on this $52 billion economy is the financial plumbing. Software cannot act with full autonomy until it can function as a financial entity. This friction exists because current payment rails were built exclusively for human operators. ACH transfers offer low costs but take up to 3 days to settle, while credit cards provide speed at the cost of high interchange fees and significant fraud risks. Regulatory standards like strong customer authentication further complicate this. Under PSD2, every transaction requires proof of identity across 3 categories. Compliance requires biometrics, passwords, or physical devices. Because an AI agent cannot provide these human-centric proofs, it remains locked out. The challenge for the next decade is building a system that allows software to spend money without creating an unmanageable financial liability for the enterprise. To decide which infrastructure to use, we have to weigh 3 specific paths based on their impact on autonomy, friction, and liability. The first path, the patchwork, involves giving AI agents virtual corporate credit cards with strict limits, settled via ACH. This allows businesses to use existing tools like Ramp, maintaining high compliance within current banking standards. However, high-value or international payments will still trigger human review, which reintroduces the exact manual bottlenecks that agents are supposed to solve. There is also a margin problem. Credit card fees of up to 3.5% can make high-frequency machine-to-machine transactions too expensive to be viable. While this is a safe entry point, it prevents the agent from operating as a truly independent digital employee. The second option involves moving away from the open web and into controlled ecosystems built by major technology platforms. This walled garden approach utilizes protocols like Google's AP2 to manage the transaction process. The system uses specific mandates for intent, selection, and payment that run through platforms like Google Pay, which minimizes the risk of unauthorized spending. This provides clear liability chains and protects the consumer, ensuring the AI doesn't execute an incorrect or fraudulent purchase. The trade-off is restricted access. The AI is limited to the platform's approved merchant network, losing its ability to find the best deal on the open web. Big Tech solves the safety problem through gatekeeping. It ensures security by turning autonomous agents into captured consumers within a closed loop. The third path bypasses traditional banking entirely, instead using decentralized machine-native protocols and digital currency to move value instantly. This permissionless rail uses crypto standards like X402 for direct agent-to-agent commerce. By assigning the AI an on-chain identity through an NFT, it settles payments instantly via smart contracts. This enables microtransactions without gatekeepers, but causes a total loss of consumer protection. Because blockchains are irreversible, there are no chargebacks. If an agent makes a mistake, the funds cannot be recovered. Choosing this rail provides the highest level of autonomy, but it places 100% of the financial liability on the team deploying the agent. The decision for any organization over the next 5 years comes down to a balance between safety and frictionless autonomy. Google's AP2 and similar big tech models sit here, prioritizing high protection at the cost of limited independence. Crypto protocols like X402 occupy the opposite space, offering maximum autonomy but providing no safety net.
Managed enterprise solutions attempt to find a middle ground by using strict orchestration to mitigate the risks of both extremes. Your choice of payment infrastructure determines what your AI is legally and operationally permitted to do. It is the primary factor in defining the risk profile of your automation strategy. If you are an enterprise finance leader, keep a human in the loop. Restrict agentic purchasing to managed environments and centralized orchestration to avoid unhedged liability. Startup founders building consumer apps, like the agents Brett Taylor is developing, should prioritize big tech protocols. Maintaining consumer trust and SCA compliance is necessary when your agent is buying products for a user. For those building B2B agents that interact purely with other machines, credit card fees will make your business model impossible. You will need to build on crypto rails to handle high-frequency microtransactions efficiently. We have reached the point where software can think for itself. Now we are deciding how it will participate in the economy. The rails you choose for your AI to spend money will determine who controls your corner of the internet economy. Choose those rails carefully.